Master candle behavior and you will master your daily candle bias. Now, every single morning when I come onto the charts, I look for one or two of these approaches on my daily time frame to define my entire lower time frame approach all the way to execution. Now, this is a brief introduction to the entire schematic of candle behavior on my daily time frame. For a continuation market on the daily time frame, meaning that Monday impulses, Tuesday impulse, and then Wednesday looks to also impulse, I'll be focusing on Tuesday's daily candle close, looking to trade that wick as price starts to distribute to the upside. However, in a day where we start to see weakness on our daily candles, I would then expect that the next day has a sweeping procedure where I'll then be looking to trade the reversal the exact next day using the previous day's high and low. And this is our daily candle close. Now, this is a secret to trading every single daily candle with consistency. As you can see right here, the closing price, you will always see a retracement into this area and then a push down lower for a bearish scenario. And as you can see with this one right here, we have that wick up and then a push down lower, as well as the next one, and they all precede this common trend. Now let's actually go enhance into our candle impulse theory, which is our CIT. It is the only way which allows to trade every single daily candle. If price closes above the previous candle high, there's a high chance that the next candle will look to exceed the following candle to continue the trend of impulses. The focus of the CIT is the close of your previous day candle, such as this example right here. And then I said you'll look to buy below this area and then look to trade the distribution of that candle. This is the variation of our daily candle close model. Our sponsor Zeek Fund is an educational platform that provides prop trading services, and they have partnered with private equity firms to provide traders with authentic trading capital, meaning that once you do get your account, you're trading with real-time live market data. And this is the only way that they're able to provide you with lightning fast payouts on an average of just 3 hours. Also allowing you to get instant refunds once you do pass your evaluation. There's zero restrictions on your trading strategy. Even if you trade during the news or in high frequency markets, they allow any trading style. They also allow and provide a clear and fair payout system, meaning once you hit your profit targets, they're not going to restrict you on your lot size or your IP address. They allow you to get accounts all the way from $5,000 scaled away to $400,000 and allow payout splits of 90%. Zeek Fund is a prop firm that I trust, and you can sign up with the link in the description to get started today. And as you can see with this schematic, it shows you with the basic open, low, high, and closing price of how you are looking to trade, as I said, the wick areas. And as well with the Thursday candle right here, we have that previous daily candle close right here, and the next candle will open at that exact area, which is why we can look for price to manipulate lower, creating that wick and then distribute, and we're trading that entire movement upward. And if you guys want more in-depth analysis on how I do the lower time frame execution, you can look into our previous video on where we also spoke about mastering the daily time frame. And as you can see, this is what we would have on our Wednesday candle and our Thursday candle on the lower time frame. Now, the next point is for us to fully understand our candle anatomy. As we spoke about previously, our previous day candle follows this simple schematic. It opens with a consolidation. It then manipulates to create the wick of the day, and then it then distributes to create the high. And lastly, once again, price then exhausts and starts to consolidate once again. And this entire cycle repeats itself for the next day candle. And this is where you can interject to find your entry as price dips back into that ideal entry zone, which is below that previous candle close. As price manipulates, you are then looking to enter and then trade the distribution and then close your positions for the day as price starts to exhaust and consolidate, and it repeats the cycle. And you can see by understanding our CIT model, we can then take advantage of all the days where price is impulsing by following this pullback. Now I've just emulated this onto a live chart. This is our daily time frame, and as you can see, here is a day we are then bullish for that day. You're looking to buy below that wick, and as you can see on your lower time frame, we open up, we manipulate lower, you look to enter at that area, and then you look to target for the relevant higher zones as price starts to distribute higher. We then apply this to the same next candle, looking to trade Once price comes below that previous candle close, makes the wick, as you can see right there, lower time entry, and then look to trade the distribution. And then you keep on repeating the cycle as price continues higher. Same thing below the previous candle close, right over here. Price dips below, creates that major wick, and then you look to enter within that wick and then start to trade the distribution as price starts to scale back up. Wednesday, Thursday, Friday, and you can see I've marked out all the midnight openings for this. An important tip, this model is meant for continuations when the daily candles are impulsing. And as I spoke about previously, in the ideal area, an impulsive daily candle would reckon that you want to buy below that candle close, which is your PCC, previous candle close. And then for a bearish day, you're then looking for that immense bearish nature where you're then looking to sell above your previous candle close and then start to trade towards the range low. Now, here's yet another example of this, but for the bearish scenario. Price creates, there's the closing of your previous daily candle. You then look to trade that wick up, as you can see right here, perfectly aligned to our lower time frame where price manipulates and you're looking to trade the entire distribution right back down for that current day. This is exactly how you are able to perfect your daily bias on a continuous basis. Now let's go into the second variation of our candle impulse theory, the tap and go, where price comes to your previous candle equilibrium. We've just spoken about price coming to previous close, but now we're focusing on refining this to both the 25% and 50% of that entire candle. You can just take your Fibonacci and then draw out these areas. And then what this creates is an ideal retracement area for your next candle to manipulate into. And then as always, you're looking to trade down towards that range low and even further from there. And this is all done on your lower time frame, but the importance is that you understand this entire candle behavior. As you can see, previous candle low, price then continues lower. However, on the next daily candle, price will then start with the start of London session to manipulate and make that first retracement. And then going to New York, you then see price then starts to distribute lower, creating the major expansion for that exact new higher time frame candle. Once again, we take our Fibonacci from the high towards the low and we mark out the 50% of that candle. Firstly, we close our previous daily candle right over there. We then open the new candle at the exact same area. We then manipulate to create the wick coming to the previous candle equilibrium, which is the 50%. And once we then start to see price impulsing higher, we are then, as always, trading the distribution to the upside. Daily to 50-minute execution. And now once again, all these candles follow this same exact mechanic. As you can see, price retraces into the 50% of that previous candle, and this continues with the next candle, the 50%, and the next candle, the 50%. And this is all emulated on your lower time frame. On every single retracement to that 50%, you are then looking to enter with that, trading the movement and expansion lower. We have just spoken about how we trade the daily candle when it is in an expansive market. However, there are two main market conditions that I focus on with the entire Novo Legacy students, which is our continuations and also our rangy markets. And in those specific scenarios, you want to take advantage of the candle range theory, which is the key to predicting every daily candle. Now, our first understanding is that our previous day candle high and our previous day's candle low act as pivot points for price. If price goes below the low, it will then look to reverse back into the range, or if price takes out the high, it will then look to reverse back down towards the lows. Our first model we want to understand with our daily time frame is our 3-stick CRT formation, the stop and reverse model. Look at this as your Monday candle. This is as your Tuesday candle, and then this on Wednesday. Once you see this type of movement, you are then expecting your current Wednesday candle that you'll be trading to be a reversal move to the downside. A simple schematic where price sweeps liquidity, wick rejects and closes back into this range. Price will then supersede to then target the range low. Now, this is the most important one, our stop and go model. This is a variation of the impulsive market, but it's simply where there's a full body candle and then right after that, your next day looks to just play within our range. With this, understand that the next preceding candle will then look to emulate the price action of the first candle, okay? First, second, third, this will then look to follow the first candle movement, which is then bullish, okay? They just see this simply as price quickly pushing up, pausing, and then continuing to push up. This is the most powerful daily bias model I use when I'm looking to validate my moves to the upside or the downside is by using the daily CRT into the daily CIT. For this example right here, we firstly use the CRT to sweep liquidity from our previous day. Take out the daily low and then we go towards the daily high. However, on the next day, given that this is now your previous daily candle, understand that your current day candle will then look to proceed with the impulse of movement. Once that candle takes out liquidity, it allows more volatility, which is why we're going to see price continue to the upside. So you then follow your CIT model, looking for that previous candle close and then a retracement into the 25 or 30% Fibonacci range, and then you target and trade towards the highs. Example, candle range theory with your candle impulse theory. Firstly, price creates a CRT of this candle right here, and then we then follow through with our candles that form out our CIT, because this is now the major draw on liquidity. Price then closes and then wicks below and then pushes up, closes, wicks below, pushes up, and you're trading every single daily candle after this until that further previous day high. Okay, once again, immediate tap and go. Price sweeps. Even having a tap into FVG is even more confidence. However, as you can see with this daily movement, you're then able to take advantage of both the move where price sweeps above and then looks to impulse lower. With this candle close, price comes back into this candle and then pushes down lower. Now the next candle sweeps this candle high and then you're looking to trade towards the lows. However, this candle will come back up, make the wick and then trade, and then this continues the entire push to the downside. Once again, taking advantage of that CIT of our daily candle and then CIT of our next day candle where price comes to the 40% and then impulses higher. Understanding this is crucial to following a continuation market by understanding the cohabitants of CRT and CIT. Once again, price sweeps liquidity and then impulses. When price is impulsing, you're using candle impulse theory. However, when the price starts to range, like with these candles right here, we then see price low sweeps this candle as low and then starts again to impulse, candle impulse theory. You're looking to trade that 50% wick all the way towards the highs. Same with this example, price creates a CRT where it sweeps the candle low, closes back above, and then it distributes to the next candle. And even once more, price then continued to distribute. So you're using your CIT with the candle close, 50% retracement, and then an impulse higher. Hopefully by now you guys are understanding the repetitiveness of this daily candle procedure, which is why you guys can take advantage of this. Now, I've seen this kind of behavior over the last 4 years of my trading journey, so I want you guys to also take advantage of this. And even more so, if you want to see me do it live, you can also book a free coaching call with me and I'll teach it to you directly. Now, coming to the next variation of our CIT, it is the close to open void. As we've previously spoken about, that the previous candle will close and the next candle will open at the exact same area. This creates the ideal area for price to retrace into and then look to impulse higher. Many of you have been in a position where you're looking at an impulsive market. However, you're looking for price to make a deep retracement into an order block or a fair value gap. However, that is never the case. Price will then instead miss that move and then just continue without you. However, if you use the close to open void gap, where we have price closes here, opens a new candle here, everything from below this area towards the 25% of your previous candle is the ideal area where price will look to make a short retracement and then impulse higher. You need to understand one key behavior by price. If price is impulsing with volatility, it does not want to make a deep retracement. Instead, it wants to make a minimal retracement, sweep out a bit of liquidity, and then continue that impulse. Remember, price always moves towards that objective. Understand candle behavior, and then you will understand and perfect your daily bias. Don't follow your mechanics, but follow the candle's mechanics. Once again, here's your previous daily close. Price then dips below that, still above that 25% area that we spoke about. You are then focusing not on all the order blocks and fair value gaps within here. Instead, you're focusing on this exact area where now you can start to buy a price and then move towards the upside. And a greater confidence to add more to this procedure is by using your midnight open. This is your midnight candle, and then being below the midnight open for your buy is the ideal area also. However, being above the midnight opening is the ideal area for a sell. And once again, simulating this onto your daily and your 50-minute time frame. Price, previous day close, then also the midnight open at that area. What does price do? Minimal retracement, comes below your previous daily close, ideal area to buy, and even more so below the midnight opening. Even enhances the confluence of that trade, and then you can just enter as price starts to impulse with the new daily candle. Once again, following that daily bias candle behavior. This is my early research into the candle behavior, which is around March 05. Okay, we had a bullish candle, and I was noticing in the early hours of the day around London session, we actually started to retrace into the 50% of our previous daily candle. And I'm now using the previous day's high as my drawn liquidity, as we're also following this bullish market. Okay, very simply how we form out our bias. First, we had two very impulsive candles, so I'm looking to use my CIT. Even more so, just seeing price create a CRT just before this by sweeping out my daily low on the previous day, we now know there's a lot of volatilities for prices to want to purge and continue higher. Now, how do we perfect this on the lower time frame? As we come into that 50%, you're then looking at what price did during the session, was then accumulating. London created that manipulation, the wick of our daily candle, and then New York started that main impulse where prices then distributing. At this area, you've already entered your trade in New York session, and then you're just looking to trade the distribution. After this, price then slowly starts to exhaust once again, coming to the New York PM session, right? And this creates that major wick for your daily candle. And as you can see right here, perfect synergy of your higher time frame daily candle and your lower time frame movements. We have that previous daily high, all right? We then come to the 50% of that area, accumulation in Asia, manipulation in London kill zone, and then distribution in New York kill zone. And then this is all being played out with our daily candle. And once again, finally, that once bearish candle tapped in that 50%, you found your lower time entry model, and then you targeted the distribution. That is all you guys need to fully now perfect your daily bias. And as I said, if you guys want to learn this more in depthly, there's a whole free course on 5 steps to becoming a profitable trader within the link in the description, which you guys can access today. And as I said, to further enhance your knowledge on this, you can watch our video on mastering the daily time frame. Now let's test the knowledge that you've learned from this exact video. Where we currently are on the daily time frame with our daily bias, candle behavior shows us that we've had preceding days where we're impulsing, closing above our candle close for the previous day, daily close, and where's our ideal area? Just below where we are wicking into. However, with our current day, we have now started to sweep our previous day low, and now we have the previous day high. With this, what do you expect our current day to do? Will it go higher or go lower? Exactly. This follows our 3-stick CRT on our day time frame. We swept with this candle, and now we want to see the next candle be bullish. So we're going to place a little buy there and then stop just below. However, with this, I'm just doing this for educational purposes. You guys are going to go into lower time frame to actually find the exact area to enter. As you can see, there's the next bullish candle. Now we still have this as our main drawn liquidity. So now we're going to be using our CIT because we know that we're going to be finding a continuational impulse in the market. Let's mark out our Fibonacci for this candle. So firstly, we want to make sure that the next current day closes above but wicks into this blue area, which is our 25 and 50% area. Okay, so we're going to place another buyer. So let's see how price plays out. As you can see, our next candle starts within that same closing price, manipulates lower, and then distributes to the upside. And we're still going to follow this exact same impulse. Candle close. This is why the CIT is the exact model you want to be using on your daily time frame if you're impulsing, because you can catch on to every single move. And with this, even though I'm showing you guys on the daily time frame, this is candle behavior. So it works on the 4-hour, weekly, monthly, 30-minute, 5, and even the 1 minute. And if you guys want a video like that, I also extend out a video like that just so you guys can get more clarification on this exact concept. But what you can do right now is either go to the link in the description and get the free course, or book a free coaching call with me. So same thing, want to see price 25 or 50% and then push up higher. And as you can see, price then follows this entire daily move. All of this was by following that one move. You saw price dip below your previous day low, targeting previous day high, and within this, price gave you much opportunities to follow your previous day close. Wick below, push higher, wick below, push higher. And you can see we're entering at that exact wick. And we go into the 50-minute to see this more clearly. And you can see our 50-minute shows this to us. We have that move where price starts off with the accumulation, manipulates, distributes higher. And where's price coming to? Our retracement of the 50%, push up higher. And here's our daily candles on this side right here, Tuesday, Wednesday, Thursday. Now, if you guys want to get more clarification on how I actually enter every single morning using my daily bias, you can watch the previous day on matching my daily time frame. And you can get the free checklist, which I use to enter all my trades, which is also within the link in the description. So now the data of using our daily candle behavior, where we make use of our previous day's high and low to figure out where the liquidity has been swept, and then using your previous day's closing price to continue the impulse moves of the market, just like how price did right over here, looking for price to fall within that blue area and then continuing this the entire time. And then we repeat the cycle of previous day high and low strategy to previous daily close strategy, okay, making use of our CRT and CIT. These on a bullish day have shown us a success rate of hitting our drawn liquidity for 89%. And then for bearish days, we follow reversals where we take out a high and then start to reverse towards the lows. With a bearish reversal, we see that we have an 85% win rate of hitting our drawn liquidity. Now this data does change because gold is by nature a very bullish pair, but if we even still apply this same kind of behavior that you learned in this video to a lower time frame, like the 5-minute, you'll notice that the performance statistics shows us that it has an 87.5% win rate by following this kind of procedure.